Welcome to the Retire with Peace podcast, the podcast where we help you create a fulfilling and stress-free retirement. Each week, we bring you expert advice, practical tips, and inspiring stories to help you plan and live your best retirement life. Whether you're nearing retirement or already enjoying your golden years, this podcast is here to support you every step of the way. Let's embark on this journey together and discover how to retire with peace.
Welcome back to the Retire with Peace podcast. As always, I'm your host, Dave Zegel. Today we'll talk about investments, but perhaps not in the way you might think. But since we're talking about investments, I'm going to throw out all these disclosures right off the bat because the compliance folks would want me to and the regulators would want me to. So first, this is not intended as investment or financial planning advice. It is for educational purposes only, and past performance is not indicative of future results. So there you go. Get that out of the way. Now we can talk a little bit about investments, and we may touch on individual stocks or company names and things like that as we go along. But again, some of the stuff we'll be talking about is in the past. So when we're talking about investments, it can be really helpful from a retirement planning perspective to be able to spot opportunities or strange things going on that they don't quite add up, that don't make sense, whether that's in individual stocks or in broader parts of the market. You can actually do really well, especially long term, if you are able to identify these things and be patient, waiting for them to come to fruition or to turn around and start heading in the right direction. I'll give an example of this from last year, 2025. Early in 2025, there was this thought brewing that when we talk about artificial intelligence and data centers and everything being built and all the chips, that we might not need as much as we think we do. Then something came out of China called DeepSeek. DeepSeek was essentially an AI app for simplistic terms, open source AI app, kind of similar to ChatGPT and others, where you could use it to search stuff, create stuff, and by all evaluations, it was actually a pretty impressive app. So this is not to disparage what was created. It was open source, which was different, and it had performed pretty well at the time. What happened though is it was publicized that it spent, I believe it was about 8 million. Don't quote me on that. I don't remember the exact dollar amount because it doesn't matter. But they said, it cost 8 million to run the final piece of testing and development on this software. Keep that in mind. It was the final piece of testing and development. A lot of people looked at that and they said, wow, they created this whole thing for only $8 million. No. You're probably going to have to add a zero, maybe two onto the end of it for the total cost of creating this and looking at how many different chips and data centers it took to run it. But they latched onto this much, much smaller number and said, oh man, all these other companies, they're not going to need all this data and all this computing power because look at what DeepSeek did. They did it really cheaply, and China's got this thing, and yeah, we're not going to need all of that. The NVIDIA chips and the electricity and the data center build out, not needed anymore because look at how cheaply this can be done. And that narrative became something that the stock market and a lot of investors latched onto. And what happened is a lot of those stocks that either sold chips or data center connections or data center build outs, all the things, they all took a big hit. They just kept sliding down early in 2025. What was really interesting and highlighted the opportunity, and we've talked on this podcast about listening to earnings calls and looking at company financial statements if you're really into that. If not, don't worry about it. But if you're really into it and want to be able to make some more money long term, listening to conference calls and going through financial statements is an awesome way to do so. I bring that up because while all that was going on, this narrative was in place that all these companies are not going to need as much. Therefore, the build out was not really going to happen. And there's this expectation that companies like Microsoft and Google and Apple, Amazon, name them all. The expectation was that since this DeepSeek thing came out, that when they reported their next earnings, these large companies were going to acknowledge the fact that, yes, we no longer need to spend as much, and therefore we can still do this, but we'll do it much more cheaply. Don't need all the chips and the computing power. That was the expectation. What happened was that these companies announced their earnings, and all of them that I can recall said, we need more. We need more chips. We need more computing. And still, what happened was those companies continued to sell off and go lower because this narrative had taken hold that these companies aren't going to need this. And apparently nobody listened to the companies actually reporting saying, more, please. We need more. And they're still to this day, a year later, saying we need more. So if you can spot that discrepancy, you can find some interesting opportunities where an investment narrative just isn't adding up with everything you're seeing and hearing and being reported by these companies consistently across the industry. That gives you some opportunity. Fast forward to now, a lot of companies, as of this, we're talking February 2026, there's a lot of companies getting hit, especially software companies and even consulting companies. There's lots of companies just getting hammered on the thought that these artificial intelligence apps that people can create very easily using something, especially like Claude, is Anthropic's Claude is the big one that people are noting right now. The thought is everybody's going to be able to create their own apps through this Claude code or something similar. So here I thought, why not test this? It's always good if you can to test something. Doesn't matter what it is. If it's a restaurant you want to invest in. I did this many years ago, long time ago with Chipotle. This is back in 2006. I mean, we're talking a long time ago. I was wanting to invest in Chipotle, so I went to a Chipotle. Let's find out, is it any good? You can do this research pretty much anywhere if you want to, shop at a clothing store, whatever. So I thought, okay, we have these new tools that allow people to make apps. I have no programming experience other than a Java class that I took decades ago back in school. So I really have no programming background. So I said, okay, let's see what I can do. Can I create an app using these tools? And I started down that process, and it was really impressive, truly amazing what can be created just by typing in or talking what you want to have in the app. So you start to think, yeah, maybe some of these companies can replace these big pieces of software with these applications that anybody can create. Maybe there's a possibility. Then you get a little farther down the road and you start to realize, well, if you're going to have certain security features to do that properly with people logging in and making sure that they can't get to the wrong areas or view the wrong things, well, you're going to have to add this to it. And if you really want your database to be structured properly, you need to add something else to it. And you probably should maybe have a programmer, engineer who can make sure that's done properly. And if you need to interface with these things, well, we have to make sure that's done right. And all of a sudden, you start seeing it's not so easy. Now, it actually is far easier than it ever has been. But to think that large companies are going to overnight or anytime in the very near future drop everything they've set up with their current software and let some people code on their own in these applications and create the softwares that's going to power their very large company. No way. No chance. I don't know. Maybe 5 years down the road, that's different. Who knows? I'm not trying to project like way out. But most executives are not going to sit there and say, "Oh yeah, we don't all this customer relationship management software. We can program that on our own." Don't worry about the security. And even some cybersecurity stocks are getting hit because, well, maybe these other, Claude or other apps can allow you to generate software to replace whatever we have for our security infrastructure. Again, I don't think big companies are going to take that risk to all of a sudden dismantle everything they have in place so some dude or some lady can sit there and code their own thing. Now, I could be wrong. That's part of investing. We could always be wrong. However, having seen this before, you realize that there's probably some opportunity here. Would there be some other applications that perhaps are no longer necessary or can be done much cheaper? Sure. Are the big enterprise companies going to rip out what they already have in place and put these new self-coded programs in where they used to have major software programs? Probably not. So now we can look for opportunities investing long term. This requires a little bit of patience, which is hard, and it may require a little bit of short term pain, we'll call it. But here's the thing, what do we talk about all the time on this podcast? How do we structure investments? We want at least 5 years that is set, that can provide us consistent income. Generally, those next 5 years of your retirement are in bonds, CDs, structured notes with some guarantees, things that we know will provide us what our income needs to be for at least the next 5 years. The rest of the money can be focused on growth for the long term. Therefore, when we talk about patience and possibly even taking some short-term pain as some of these areas of the market maybe continue to go down a little bit, if we understand the trend here and what might be happening, what might be missing, what's not congruent, just like we talked about with the DeepSeek example from last year, nothing really matched up. The narrative of they were not going to need as much data center didn't match up with what the large companies were doing and saying, that they needed more. Now we have something like this in software. We can say, yes, these coding tools are awesome, but maybe not ready for prime time yet. Maybe all these companies that are getting hammered are still going to be okay long term. That's what we care about. We want our money to grow long term, knowing that we have at least 5 years set aside out of the market. Now, this is just one example. There's plenty of other examples where parts of the market or specific stocks get beaten down because there's just this narrative that they're going to struggle because of X, Y, and Z. Sometimes that actually comes to fruition, but other times, if you're paying attention and you're really following, especially what the companies are saying and doing, there are some fantastic opportunities out there. You have to be patient. Might be slightly painful in the short term, maybe even medium term. But if you've really done your homework and you've really dug in to understand why the narrative might be incorrect, you can make a good chunk of money. And we've done this in the past. You can make a good chunk of money if you're willing to be patient and let that play out and let that incorrect narrative fade away over time. There's extra profits to be had that can enhance your retirement. So that's why we bring this to you today, to help you get more out of your retirement. We need to structure things properly. Have your safety net in place, at least 5 years of income out of the market. Bonds, CDs, individual bonds, CDs preferably. It's preferably individual bonds. You can add in CDs, structured notes. That way, the rest of it can be built for growth and you can get more out of your retirement long term with that growth.